Mom, it went on.
Yep, we're good.
We're good?
I see.
Good morning, everybody. Patrick here. Sorry for the interruption here. We have a very strong market here in metals. Continuing to make new highs. We're going to watch the market here today. Markets are in a fast condition to the upside for the metals here. Gold is breaking out. 1787 target has been completed. Silver is up over 80 cents. So continue to hold your long-term position here, and the recommendation that we've been suggesting here for the last couple of weeks, particularly on September 28, anticipating the seasonal low that took place here, that's unfolding. What you see here is basically the market retrieving or retracing back to the levels of support that the AI basically identifies as the area where you want to accumulate supply. And what we see here is the market breaking out pretty much from the level of support into the average price in closing, trading above 24.12. Is going to break out to the upside. A close about 24.12 brings in the targets of 24.54 to 25.11 on the weekly. Gold is trading above the trend line, Fibonacci resistance, above the average price daily and weekly, so we are in a bullish price momentum. The targets on the weekly are 1808 to 1830. Silver 2408. Bitcoin is holding this area and consolidating around the daily average and the weekly average. Above the daily and weekly average has activated a bullish price momentum with a target of 65,265 to 67,745. Palladium is reverting to the upside here, following the metals, and it looks like a very nice bottom is in the making. Copper has retraced back slightly, and basically we're looking to get long on copper up on the next signal when activated. We have Nugget, which is a XX ETF in precious metals, made a bottom yesterday from the buy 2 level, as you can see, of 47.26, tested it, reverted right back up. Now it's activating a buy trigger from the daily signal of 50.23. The target, the initial target, is 53.23. Closing above there will give us a target of 56.24 in that vicinity. The higher target for the week is 59.20 for Nugget. Very nice, what looks to be a head and shoulder bottom in the silver market. We're challenging that 24.12 target, which will activate the 24.54 to 25.11 targets. Trading above 24.04, which is the sell 2 level on the daily, neutralizes the daily program. And the VCPMI at that point looks for the weekly levels, and what we see here again is a close above 24.12 is activating 24.54 to 25.11. GDX, the mining share index, the miners GDX index, trading at 32.35, reverting again from yesterday's buy trigger at 31.14. You can clearly see the reversion unfolding. The reversion from the average price, which activated the buy 1 and buy 2 levels that were completed, and then once we get to the buy 2 level, then you're looking at a high probability mathematically of about 95% that the market will find buyers here. Not only will find buyers, but upon confirmation of the trigger point, it activates the average price again of 33.01. You can see the reversion here unfolding and completing the pattern. GLD. GLD is up 216 in a gap opening, as you can see here. Very strong reversion occurring. I want to share with you the latest report that came out this morning. U.S. weekly jobless claims fall to new 19-month low. The number of Americans filing new claims for unemployment benefits fell to a fresh 19-month low last week, suggesting the economy was regaining momentum and a significant improvement in public health, though supply constraints remain. Initial claims for state unemployment benefits fell 14,000 to a seasonally adjusted 269,000 for the week ended October 30th, the Labor Department said on Thursday. That was the lowest level since the middle of March in 2020, when mandatory business closures were being enforced to slow the first wave of COVID-19 infections. Claims have now declined for 5 straight weeks. Now, this came in on the face of the Federal Reserve leaving interest rates unchanged. And that is basically the underlying strength that we are seeing in precious metals here today. The fear that interest rates were going to be raised, obviously, and the general interpretation of people about interest rates with regards to the precious metals markets is that it is a bearish indication. Obviously, if you look at it in general, an increase in interest rates is actually bearish for the market as a whole in terms of the cost of financing this over leveraging that has been going on. The market is completely over leveraged, and it doesn't have any indication clearly in terms of when we are going to begin to see, if any, reduction in that leveraging. And as interest rates rise, it increases the risk of that leveraging, that over leveraging, pretty much being liquidated as a consequence of the increase in the cost of maintaining that leverage. And that goes for the US debt as a whole. If we're looking at the total picture, is getting closer to $30 trillion. And if we get a 1% rise in interest rates, it's basic math. You can calculate the increase, the tremendous increase in the amount of the cost of maintaining such debt, and obviously would put a tremendous pressure on the budget as well. So with this debt that we have globally, basically it's precarious and very risky here if interest rates do begin to rise. So we have to see and hope that the tapering or the increase in interest rates is going to be a gradual interest increase, not to pretty much scare the markets or have a temper tantrum, as they call it. So what the Feds or central bankers are doing, basically, particularly the Feds, is beginning to talk about the possibility of tapering and raising interest rates so that the market gets used to the language, gets used to the possibility that that is going to happen, and begins to discount that possibility. And so what you see here in pretty much across the board is the markets are discounting that possibility, which is saying that the markets are willing to sustain this level and pretty much be able to digest the increase or the adjustment in values that we are seeing as a result of the weakness of the US dollar. And so if the Feds see that the markets are not collapsing, that they're pretty much stable, as we saw yesterday after the announcement of the Feds basically going neutral, but talking about beginning to taper. And so they are discussing it verbally, basically, by trying to make the distinction about tapering in raising interest rates. There is a big difference. So they want you to see, or want us to understand. And so what the market is perceiving right now is that interest rates hikes are going to possibly take a little longer than we would like to, which is great for the market, and that's what the metals and the markets in general are beginning to digest. That fear is going away of rising interest rates. And it is discounting, obviously, this possibility of tapering beginning sooner than later. And tapering is basically the reduction of the government in the purchases of government bonds. And so in a way, by draining the market of that liquidity, they hope that it stabilizes the market enough that at some point the next step would be to consider raising interest rates. But that is another argument, that is another factor that I think the market hasn't yet being affected by it or anticipates that happening anytime soon. So we're beginning to see obviously a big move up here in precious metals as a consequence of the adjustment that we are beginning to see the economy is making to the current levels of inflation. It appears that the economy is growing faster than anticipated, or the demand is growing faster than anticipated into a bottleneck of supplies that essentially are affecting across the board, from computer chips to plastics to all sorts of products that are primarily durable goods. One of the markets that I am looking at, that I recommend and I have recommended to take a position on, is in corn, grains, as a consequence of what we believe will be a potential shortage of food here as we enter into the wintertime. So the grain markets are the only ones that are undervalued right now to this possibility of a shortage. It has not yet discounted that possibility. And basically, I think even though we may have grain available, I think we're going to have logistical problems of transportation and shipping these goods enough in time before they perish. Governments are subsidizing farmers to kill their crops. So we're dealing with a different dynamic in the grain markets that I believe is what it's called a short squeeze. We have inverted markets which indicate a shortage of supply. So maintain your long positions in metals, maintain your long positions in grains, and I'll see you next time, my friends. Thank you again for the opportunity to share this great information with you. I hope you're taking advantage of it according to your profile. In the meantime, be well, take care. I'll talk to you next time.